Dhanteras 2025 Tax Guide for Gold Jewellery, Coins, Gold ETFs and Sovereign Gold Bonds. As Dhanteras and Diwali approach, the allure of gold remains strong. While physical gold continues to be a popular choice, investors are increasingly exploring more tax-efficient options like gold exchange-traded funds, ETFs, and sovereign gold bonds. These alternatives not only offer portfolio diversification but also come with distinct tax advantages. Gold ETFs, flexible and tax-efficient. Gold ETFs allow investors to gain exposure to gold prices without owning the metal physically. These mutual fund units are traded on stock exchanges and their tax treatment varies based on the purchase date and holding period. For units bought before April 1, 2023, gains from holdings up to 36 months are considered short-term and taxed at the investor's income tax slab rate. Gains from holdings beyond 36 months are treated as long-term and taxed at 20% with indexation benefits. For units bought between April 1, 2023 and March 31, 2025, all gains are treated as short-term and taxed at slab rates due to the removal of indexation benefits under the Finance Act 2023. For units bought on or after April 1, 2025, gains from holdings of 12 months or less are short-term and taxed at slab rates. Gains from holdings over 12 months are taxed at a flat 12.5% without indexation as per the Finance No. 2 Act 2024. One major benefit of gold ETFs is the ability to offset capital losses. Short-term losses can be set off against both short-term and long-term gains, while long-term losses can only be offset against long-term gains. Unused losses can be carried forward for up to 8 assessment years. Sovereign gold bonds, long-term tax benefits. SGBs issued by the Reserve Bank of India offer a fixed annual interest of 2.5% along with exposure to gold price appreciation. Their tax treatment is particularly favorable for long-term investors. Interest income is taxable under income from other sources at the investor's slab rate. Capital gains on redemption at maturity after 8 years are completely tax-exempt, making SGBs one of the most tax-efficient gold investments. If sold before maturity in the secondary market, for sales on or after July 23, 2024, the holding period for long-term capital gains has been reduced to 12 months. Gains from holdings over 12 months are taxed at 12.5% without indexation. Gains from holdings of 12 months or less are taxed at slab rates. Physical gold traditional but less efficient. Gold jewelry, coins and bars are taxed differently and come with additional costs like making charges and storage. For sales before July 23, 2024, a holding period of 36 months qualifies gains as long-term, taxed at 20% with indexation. For sales on or after July 23, 2024, the holding period for long-term gains is reduced to 24 months. Gains are taxed at 12.5% without indexation. Short-term gains are taxed at slab rates and unlike SGBs, physical gold does not offer any tax exemption on maturity. Choosing between gold ETFs and SGBs. Gold ETFs are ideal for investors seeking liquidity and flexibility as they can be traded anytime. SGBs with their 8-year tenure and early exit option after 5 years suit those with a longer investment horizon. According to experts, the choice between these instruments should align with your financial goals, investment duration, and liquidity needs. Gold ETFs offer market-linked returns and loss set-off benefits, while SGBs provide fixed interest and tax-free redemption. Optimizing tax efficiency. Both gold ETFs and SGBs help investors avoid the challenges of physical gold. Maintaining accurate records of transactions is essential for tax compliance. A balanced approach that includes both instruments can enhance portfolio diversification and tax efficiency. If you find our content valuable, we kindly invite you to subscribe to the channel to stay updated with our latest videos.